The following is a presentation of TFNN. Live at TFNN. The Money Masters. Now, the Money Masters.
Good morning, Money Masters and Treasure Hunters. Welcome to the March 12th terrific Tuesday edition of the Money Masters Show. I'm your host, Steve Rhodes, and thanks so much for joining me, folks. I absolutely treasure your presence here today, and my outcome, as always, is to help you to become a better money master and to provide you with the tools that empower human potential. Because living up to our potential, folks, that is what we must master each and every day. I want to say thank you to one of the masters out there, Basil Chapman. Basil filled in for me yesterday while I was away from the mic, and thank you, Basil. Tom filled in for me for the first hour yesterday, so thanks to both Tom and Basil out there, two great masters that can help you attain your potential, your full potential, day in, day out. Let's go take a look at the potential here of the markets. We've got the Dow Index right now up 16 points, trade out at 14,464. S&P is flat, down 10 pennies right now. A composite off $4. Russell 2000 up 7 pennies. Microsoft is down 3. Intel down 4. Google's off $8. We'll take a look at the Google chart. Apple's trading out at 435.25, trying to stay and tread water, trying to stay above that 435 level. That is a little miniature area of resistance. It gets up above it, which it did yesterday, closed above it. That can become some support. That'll put a little fuel in the fire there for the NDX 100. We'll take a look at the NDX, all the indexes, anything that you'd like. Our call number is 877-927-6648. Give us a call. We can look at your stock chart as well. And as we kick things off here, let's start off by taking a look at the S&P 500. The S&P 500 this morning, we were taking a look at the ES Mini. I'll do this on the S&P 500. And the importance here is just simply understanding your Fibonacci retracement and expansion levels. Now, if you're watching us on Tiger TV, little blue area, at least that's blue area is what it looks like on my screen here. The blue area is a 1.272 butterfly pattern. What's the importance of that? It's understanding, though, that is a normal area where you would expect to see a reversal. In fact, in the 1.272 butterfly, you did have the bears. They came out of hibernation. They did it for one trading session. They came out on February 4th, gave you a bearish candle. That is what you want to see at the formation of any pattern completion out here. Wait for a bullish or bearish sign. In this case here, you would be waiting for a bearish sign. Now, if this area fails, means you get a significant close above the level. In this case here, that level being somewhere about 1,515, we'll call it. Then where's the market going to break out to? It's going to break out to the 1.618 level. We take a look at what is that expansion. We'll come and take a look at our swing points in the S&P. That's the September 14th high. The S&P cash is 1474.51. You can do this on your SPY chart as well, all the way down to the November 16th low. That low was 1343. How about that trade at 1555? Already a 210-point move out there. But the 1.618 expansion, those two swing points, folks, 1556 out there, right around 1556. I think that's what it says. It's hard for me to read that far away. But what that's in essence, that's where we're trading at right now. So you're trading at a 1.618 expansion. Now, what's interesting here, is this a short? No, I don't think it's a short. Why is it not a short? It's a good question. It's not a short because you haven't seen the bears show up. At least wait for the bears to show up here. If you were to take the short position right now, especially after seeing nothing but up closes here, because who's in control of these trading sessions? Who's clearly in control, volume or not? It's clearly, with regard to the close, it's the bulls that are in charge here. Now, we take a look at these candles, with the exception, last time we saw any kind of conviction behind the move was March the 5th out there. I'm not talking volume. I'm just looking at the candle patterns out there. At least you had, a fairly wide-ranging bar. You went from a low of 1525 up to a high of 1543. So you had, almost, a 17-point move or so. That was a little bit of conviction there when you take a look at that candle session. If you take a look at yesterday's candle session here, it's not that much. There's not much work that the bears would have to do in order to engulf yesterday's candle. What would they have to do? You'd have to see a close in the S&P today below 1551.15. If it closed below 1551.15, you would form a bearish engulfing candle. That's all you need. You don't see the bears. Why should you jump in front of a train out here? Because it could be, there's always the light at the end of the tunnel, right? The thing is, you want to make sure that that's not a train coming at you. In this case here, in my opinion, if we were to take the short, that would be like the train potentially coming at you. Instead, when you take a look at these expansion patterns out here, and I'll go ahead and we'll get rid of this. We'll draw the new butterfly pattern in here. What I think is the beauty of these expansion patterns, and didn't mean to grab that one, is the beauty is that the retracement, which will occur, the retracement on expansion patterns, even a dead cat bounce, is a substantial retracement. And I'm glad you asked me, what does that mean? Well, all you would do is go from the swing point low, November 16th low, all the way up. We'll put it to today's high out here, and then around the 1555 and change level. The 0.382 retracement takes you into 1474. Oh, what else? We got friends at 1474. We've got the 1474.51, September 14th swing point high. That was an area of resistance out there. Now, we'll see if this will act as support. But you're talking about going from 1551 to 1474. Do you need to sell the top tick out there? No, I don't think so. In fact, I wouldn't even recommend it. It's so easy. That's why you really want to understand your bullish and bearish candles out here. If this was a wide-ranging bar, then you might want to think otherwise. You might not wait for the entire bearish engulfing to reveal itself. But in this case here, you're only talking about having to get to 1555, 15. That's nothing. That's 1550. That's nothing. That's 4 points, 4 to 5 points out there. I would easily give away 4 to 5 points to give me the better reward to risk. And when I mean reward to risk, is at least to have the move start reversing and going in your direction. And what would you do? You would close the trade out when it gets. You have to give it some room out here. But if you'd like to understand what kind of room to give a trade, go to the homepage of tfnn.com. In fact, I'm going to do that right now, so that way we'll take care of a little bit of house cleaning as well. Go to the homepage of tfnn.com, and over on the left-hand side, you'll see a little up arrow and a down arrow. Here, you'll see the power of position sizing. Go check that out. It's a little position size tool. Helps you understand the average true range. Helps you to understand where you ought to place your stops. Plus, there's a 30-minute video that explains everything to you. So if you haven't tried the position size calculator, please go to the homepage of tfnn.com and do that. You can also catch Tom's appearance yesterday on CNBC from 7:30. So he was pulling all kinds of duty yesterday. CNBC coming in here, filling in for me from 9 to 10. You got to love that guy. I do. And then what you can also do is, folks, this coming Saturday in the San Mateo area, both Tom and Daryl will be doing a workshop from 8:30 to 12 noon. All the details on the homepage of TFNN.com. So if you're anywhere near San Francisco, I recommend that you go out there. What a great way to spend your Saturday. All kinds of prizes and gifts. But the prizes and gifts, even though they're valuable, like $2,500 plus, it's nothing compared to the education that you will get out there. So all the details on the homepage of tfnn.com. Go over there and sign up for that. And also in that position size tool, it'll help you to understand where you ought to put stops. Let's go take a look at some of the other indexes out here. Let's pull up the NDX 100 as we take a look at the NDX. Where is it? I must have deleted. No, here we go. It's right in front of me, just a little bit over to the right here. If we pull up the NDX 100, we can see the NDX has formed a 0.786 Gartley sell pattern. That still is really in play today. If you take a look at the actual 0.786, looks like about 27.96. Right now, it's trading out at 28.06. That's 10 points. That's not enough for me to have broken a pattern. But is it important to understand this pattern? It's extremely important to understand this pattern. Why? Because we can see this 0.786 area. Now, and what happened here is you can take a look at this gap up. Remember, I was talking about the March 5th candle when we were looking at the S&P 500. Well, if you take a look at the NDX 100, you can see you've got this gap up. So you might take a look at this candle, and what I want you to always do is how I want you to go ahead and treat gaps, because understanding the power of a candlestick is very important. And oftentimes people will overlook the gap because we're so visual. And how we learn is absolutely visual. I mean, it's not the only way that we learn, but when you put visual and audio together, your learning aptitude increases by a huge percentage out there. But I think it increases by about 70%. That's what the studies show. And what I want you to do is when you see a gap, what you've got to visually do in your mind is you've got to fill this in. fill this in to the close of the previous bar out here. So if you take a look at that March 5th session out here, it's one of the strongest candles. In fact, it's the strongest candle since January 2nd that you would see to the upside inside the Index 100. Is that important to understand? Yeah, I would say it's important to understand, especially if you were short at this stage of the game here, because you've got nothing but strong candles really to the upside. You've got just take a look at it. You've got this reversal day, this key reversal day trading session that goes back to November 6th. Then you have a gap up. Remember, if you fill in this bar here, that's a pretty strong candle. How about the bar here from November 23rd as it gapped up? Go ahead and fill that in. You've got a strong bar there as well. But take a look at the strongest bar, period. Take a look at December 31st. That bar there, that would be a 1.5 in my Richter scale of 1 to 10, with 1 being the strongest as far as strong trading sessions out there. And then take a look at the following trading session there, certainly on January 2nd. Well, that bar there, if you go fill it in from the close of December 31st all the way to the close here, that is one heck of a wide-ranging bar out there. So that's why these gaps are so important, and you can learn from these gaps. In the case of the NDX 100, the easy way to identify how strong that gap was just simply take a look at the test. Take a look at the area of support. That happens to be this red horizontal line on the bottom of the gap area, how that has held out there. And so right now, what's so important about this? Well, first, it allows, in taking a look at these candles, it allows you to truly be the psychologist of the marketplace. And that's really a key to what it is that you're doing when you're trading out here. You need to be able to understand what the message of the markets is. Now, what we have is, because we have had price moving sideways for 4 or 5 days, ever since this very strong candle session here, should have been able to move higher than that. So that says, something to think about. Plus, we've got this 0.786 level that has held. Now, if this area gives way, and I mean breaks topside, not only will the NDX 100 go up to the highs here that form this Gartley sell pattern. That's the high of September 21st. That's the level of 2878. What it is more likely to do, it's more likely to make an expansion program. Now, I'm giving you a bigger picture, a longer-term picture, not like something that's going to happen today or tomorrow or what have you. But it's important to understand. It's important for all of us to understand, certainly the NDX 100, especially with Apple in the mix here. Apple right now trading below the 435 level. We know it's trying to punch in. We know that Apple has more work to do to the downside. That doesn't mean that it can't have some counter trend rally out here, but the NDX 100 certainly an important stock chart for us to be paying attention to. We take a look at the other index charts out here. We can see, let's pull up the VIX. The VIX yesterday getting back into the I don't remember, 2004 lows and 1994 lows out here. This candle did gap up from yesterday's close, but that is not really a bullish candle out here. In fact, it's a bullish harami, which is not a reversal signal, at least not just yet. The VIX was down 8% yesterday. Let's see here. In early trading, the VIX is up about 2%, up 22 pennies out here. 877-927-6648. Gold is up 17 bucks, a little over 1%. Silver up 39 cents. We'll be right back, folks.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
Welcome back, folks. Dow up 30 points. S&P just turned slightly green, up for 44 cents out there. Composite down 6. Small caps off 37. Back to the S&P here just for a moment. We have the weekly chart on the screen. Weekly chart shows that beautiful rising price channel that has contained price off of the March 2009 lows. Now you are into the highs again. This is the weekly chart we're looking at. And what the S&P is doing is trading into the swing point high. The October swing point high, that is October, the week of October 12th out there. The top of that swing point, 1576.09. The bottom of the swing point, 1546.72. We were taking a look, remember, at the daily chart. We were taking a look at the 1.618 butterfly sell pattern that is out there. Was saying, do you have to sell the top tick? No, unless you're trying to prove something. Instead, you want the market to prove something to you versus you prove something to the market. In my opinion, that is the better approach out there. So we took a look at, I think it was 1551 was the level of being able to form a bearish engulfing. But when you come back to the weekly chart, what you really want to see out here is you really want to see it close below 1546.72. So is the bearish engulfing, if it were to form today, and I'm not saying it is, but just what is important about showing up to work each day and taking a look at a stock chart is being able to define what it is that needs to happen, both from a bullish and bearish standpoint. When you show up and you take a look at any stock chart out here, no matter whether you're in a position, in fact, if you're in a position information, it's even more incumbent upon yourself to be able to identify both the bullish case and the bearish case. So out here, we're taking a look at a possible bearish reversal signal because we know those 1.618 expansions, it's a very expanded rubber band, a very likely spot where we're in a range where we would see a reversal take place. Now you wait for that to happen. Just doesn't mean that it's going to happen. And if it does, I gave you the first bearish signal. I would say the bearish signal, since all you're doing is clearing the swing point, you really want to see, because what's the difference between 1546.72 and 1551? Yeah, it's only 4 points. What it is, it's more conviction because you would get back down below the swing point from October the 12th, 2007 out there. To me, that would be a great price to pay. Always pay. You're going to pay for information one way or another. I say just always show up, take a look at the stock charts, and make sure that you look at multiple time frames out here, understand what's going on inside the weekly, the monthly, the daily, and then understand what some type of intraday chart. And always remember this, in my opinion, is when you're starting to take a look at an intraday chart for a vehicle that trades 6.5 hours a day, an hourly chart doesn't do you a whole lot of good, because you can't divide 6.5 hours into equal bars on a hourly chart out there. So if you're going to do intraday, make sure you're using something that divides equally, like a 30-minute chart. In my opinion, much better than a hourly chart to give you information about something that is trading. That way, you know, when you're taking a look at volume and so forth, and you take a look at the size of the bars to be able to give you information about a marketplace. Now, you're trading currencies, the futures marketplace, that's a whole different scenario out there. But if you're trading, you know, an ETF, don't the hourly charts kind of lose their meaning, because you've got to always go back and take a look at that last half hour of the day and try to connect a bunch of dots out here. So 1546.72, not until you see it close below that, in my opinion, should you really start looking for a bearish outcome. Now, the bullish side of this is 1576.09. You're already trading inside there, not you, but the S&P 500. No reason for it not to climb Mount Everest and try to get up over the 2007 level before it gives you its next piece of information. That again, 1576.09 out there in the S&P 500. As we take a look at stocks here popping and dropping, let's go take a look at Cabela's Inc. CAB is the ticker symbol. I like that as a ticker symbol out there, CAB, because I like Cabernets. So as we take a look at Cabela's, up 10%. That's up $5.57 points. This is clearing an area. This had yesterday traded into a area of resistance. Looks like that resistance area got the window was fixed, slightly fixed, and that what I'm referring to there, I'm going to draw a red line. There we go across the screen. We're taking a look at this breakdown in Cabela's. That is from the trading session of October 24th. That's where it really broke down by gapping down the next day. So if you visually go ahead and fill in the bar here, you know, instead of taking a look at the chart and just seeing the gap, mentally go in there and paint the rest of the bar here. Is that a wide-ranging bar or what? It most certainly is out there as it gapped down, and it did it with volume. Now, what this equity did was on Friday, it actually closed the window. You can see how this acted as an area of resistance. It was only tested once. You like to see at least 3 tests of an area of resistance or support in order to really cement a good line out there and to give you a good read. But the first time up there happens to be March the 6th. Gets up there with 518,000 shares coming into 570, coming into the actual breakdown session. So that was a pretty nice test on lighter volume. That window, though, there was the repair workers were out the following trading session on the 8th. Once it closed up above that, that area really no longer existed as an area of resistance. 877-927-6648. That was on Cabela's Inc. CAB. We'll be right back.
Just recently, on December 28th, Market Insight subscribers were advised to go along the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91. And only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insights subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Welcome back, folks. 877-927-6648. Right now, the Dow is up 23 points. And let's continue taking a look at some of the charts here, popping and dropping. Let's go peek in on Google. Haven't looked at Google here yet this morning, so let's go see what Google is doing. Important for us to be paying attention to Google because this is one of the leading stock charts out here. In fact, it's more of a leader than Apple for sure. So let's go ahead and clean up the stock chart out here. And as we take a look at Google, Google had gapped up, so certainly visually you would go ahead and fill in the gap just to understand the candle session. That candle session, when Google did gap up on March the 5th, that's what I'll call a type 1 candle, a 2 back-to-back type 1 candles out here. meaning March 4th and March the 5th. So I would really stitch those two candles together just simply to give you an idea of the strength behind the move. Of course, we can see here on March the 5th, if you're watching this on Tiger TV, what you're seeing at the bottom of my screen, one of the bottom portions of the bottom of my screen, the relative strength indicator, you can see that Google getting into that extreme overbought territory. We know when an equity does that, when it gets into overbought or oversold, that it needs to work that condition off. And so what is Google doing right now? Just simply traveling sideways, working its way off. And you work your way off, not you, but the way a stock will work its way off of being either overbought or oversold is either pull back or just simply move sideways. In this case here, we take a look at volume. So far, volume today, about 595,000 shares, an hour's worth of trading. This is after gapping up with 4 million shares. And as well as they had about 3 million shares into the prior session on March the 4th out here. So Google really backing off with some light volume. Yesterday did only about 1.5 million shares out here. So Google's price behavior really not bad at all in the marketplace. It's inside the, it looks like it's inside the gap, which you want to pay attention to. In the case of Google here, we're going to use that gap just like we do on the NDX 100. That is now the low of the March 5th area. That is 828.90. That level has been tested, we're going to say twice out here. It got down to 829.58 on March 7th. That's close enough for me and my work. Then on the 8th out here, it actually got down and closed back above it. Today you're trading below it. If today closes back above the level of 828.90, you'll have a pretty strong area of support inside Google. If not, all it's going to do is come back here and fill the gap, that top of the gap, which I suspect is what it really wants to at least do intraday, and that's get to the 822.84 level out there. If it and that is, so you've got level 1 and level 2 areas of resistance out here. The red being level 1, the black line going across the screen being really your level 2 area of resistance. If in fact Google, because we can call this a little bit of a breakout session, if in fact Google will close inside 822.84, then it should come back to the bottom of the breakout. That bottom of the breakout area being 805 might be a buy on lighter volume out here. But so far today, the trading session, Google doing nothing more than working off an oversold condition and backing down with some light volume out there. So that is on Google. Let's go take a look at Grainger, GWW. That's off 555. Let's go see what that is doing in the marketplace. GWW. Gapping down. You know what I'm going to do? We're going to pull up a stock chart that happened to be a residual stock chart from last week that we were taking a look at. But we can see here Grainger gapping down this morning, but the bulls have rushed in. So far it's forming a hammer candle as it came back and it's testing. So you got a little bit of a breakout area, and breakout area just simply referring to an area here where it broke out and gapped on February 12th. We'll draw that candle across the screen. Let's go ahead and put that in black. What Grainger has done is come back and tested the previous swing point low. Let's put that in red. Now that swing point low only has volume of 285,000 shares. So far today, it's done 228,000. But take a look at who's in control of the session here. Just if you were to negate, if you were not to look at the gap. Now, you need to look at the gap here because you see how this is a hammer candle? Looks like a hammer candle right now. Really, you still need to fill in the body of this candle. So if I asked you to fill in the body of this candle for the gap, that would be from yesterday's close. I wish I had a little tool here that would allow me to draw extra boxes because that would help you to, I think, visually better read the message of the marketplace out here. So if it were, you would see this as a hammer, but you need to be able to fill that area in because to me this still says the bears are in control. Volume-wise it is, but we can see we're in areas here where the bulls want to be able to defend their position. Likewise, let's go back and take a look at this stock chart for Select Comfort when that was the weekly chart. As I was just simply going and cleaning up the stock chart session here earlier, let's go take a look at SCSS is the SCSS is the ticker symbol. Now, last week, this thing was, this is the weekly chart that we're looking at, gapping down with volume. And take a look, this did form a hammer candle last week, but with major volume, but also really coming into that red horizontal line going across my screen here, truly is an area where bulls were inside this equity. This goes back to April in 2011, and truly they are defending their positions here. It's where we last saw any kind of real significant breakout to the upside as this came off of the lows. This came off of the lows back in 2009 like everything else did, or most everything else, I should say. But what we can see here, the area where the bulls are defending their position happens to be this line. So on the weekly chart out here, you've got a weekly hammer candle, and this week here right now, so far what's formed is a bullish engulfing candle. On the weekly chart, that's not too bad out here, but you do have some pretty significant volume to the downside. I wouldn't recommend getting inside this equity here. We can see on the weekly chart, though, I mean, if you were going to buy it, now would be the time to do it. So if that were on your list to get in, because you do have also on the weekly chart getting down into the oversold territory. So it has to work its way off. And the reason why, if you were looking to get into this equity, the risk-reward actually might be okay. You would close out the trade if it closed below 1662. At least that's how I would trade it, because you have a weekly hammer candle. And a weekly hammer candle, that's some important information out there. Now, of course, it looks like a hammer. But now if you go take Steve's visual training and you go ahead and fill it in, you can see not really much of a hammer out there when you fill in the gap. So those are the types of little nuances that are always involved with any kind of stock chart out there to help you to be able to take a trade or not, and help you to be able to better read the message of the market. Just like if I go over and take a look at the S&P 500 again. If we go take a look at the S&P 500, I'll give you a little gold nugget out here, what I consider to be a gold nugget. If we take a look at the S&P 500, coming all the way back to November 16th out here, if you take a look at that trading session, I'll go ahead and get rid of the blue on my screen. For those of you that are following along on the Tiger TV or watching us through the den, it's easier for you to see. Maybe you're listening in on the radio or your mobile device at tfnn.mobi. Remember, the archive of this show is on Channel 10, so you can come back, and that way you can visually see what it is that we're looking at. And I want you to take a look at this trading session as the market was moving down back in November 16th, as the market was moving into the oversold territory by dipping below the 30% line of that relative strength indicator. You got a key reversal day. The key reversal day requires three things, folks. Probably want to mark this down. Number one, you need to be in a condition that is extended. Well, if you don't know how to measure extended conditions, either butterflies or expansions of swing points and so forth, you most certainly can use the relative strength tool. If you're down towards the bottom, this case here as the market's moving down, you're in extended. You're in an oversold territory. That's an extended condition. Likewise, if you had a key reversal day as the market was moving up and you're up in that 70% or 80%, above 70% level, you're in an extended condition. That's number one that you have to have. You also need to have you need to be able to trade above and below, in this case here, the prior session. Well, if you take a look at the S&P 500, the prior session high was 1360. Let me get it right. 1360.62. Intraday, the S&P got up to, on the following session, got up to 1362. That works for the high. How about the low? The low says you get to 1348. What happened? You got below the low. You can visually see that. And that is a second condition. Number three is that you got to close in the opposite direction of where you were coming from. There was nobody that wanted to buy the market on November 16th. I remember because I was filling in for Tom. My clients and I, we bought the market on November 16th, as well as the prior session out there, or two prior sessions out there. And remember getting cards and emails, letters, which I love getting those, by the way, Steve at tfnn.com, and folks saying, why would you go long the marketplace? Well, you go long when you get different types of reversal signals. Now, we all have different tools that we use, and a key reversal day is very important when you put it together. Why is it important? Well, it's where your back is up against the wall. It didn't mean the trade was going to work out. Just because you get these patterns does not mean the trade works out. It's why you don't back up the truck. It's why you go ahead and use money management out here. What it meant if you had gotten it closed below that key reversal day, the S&P 500 below 1343.35 wasn't a hammer, but to me would have said, hey, you know what, you're wrong on the trade right now, and just step aside. Well, if we go and take a look at a lot of talk in the den here I see between the XAU, the HUI, the NUGT, the GDX, all of them. Well, if we go take a look at these out here, I got to put it up on my screen, so we'll go do that. and take a look at the pattern. Where is it? GC. There we go. We'll take a look at the gold contract. Now, I'm going to go ahead and pull this back. This is the XAU that we are taking a look at. So if we take a look at the XAU, which is the Philadelphia Gold Silver Trust out here, we can see right now trade out at 136.40. Take a look at just using that relative strength indicator out here. RSI, you can see dipping really low, getting down. I got to put the, let me put it up on the screen here for you. Maybe over on the left-hand side, you can actually see the reading, 23.62. So certainly, if you just use this indicator, was certainly in a extended condition. Of course, I'll give you another extended condition out here. That condition is the butterfly cell pattern. Take a look at this. You've got a 1.272 butterfly cell pattern. This is in the XAU. Now I'll go ahead and erase that from the screen. So you got two things out here that give you a expansion pattern, extended condition, as you need to have for a key reversal day. Why won't this delete? There we go. Now as I back this up, take a look at this prior session being March 5th out here. You can see the high is 131.30. The low is 128.79. You can see the prior low on the session of March 6th, 127.89. It gets below the prior low. Certainly engulfs the entire session. In fact, not only does it engulf the prior session, it engulfs really almost the last three sessions. So that gives you your key reversal day, just like we were taking a look at the S&P 500. And there were folks that did not want to be believers out there as well. Not saying this trade is going to work out. It is a trade that I'm in, and it becomes an easy trade. Your back is up against the wall. We get a close below on the XAU, the HUI. The XAU closed below 127.89. Then the trade was wrong. It's as simple as that. And so that is a key reversal day on the XAU. Let's go to British Columbia. And to our man, Rick. Rick, thanks for calling. Thanks for holding. How are you today?
Hey, really good, thanks.
Good. You wanted to look at the consumer staples sector, which everybody is talking about. Consumer staples.
Well, you got retail sales tomorrow. I don't know how big of a deal that is. But I look on a longer-term chart.
Yeah. What time period?
Well, go monthly, weekly.
Yeah.
I go 1 year weekly for starters, and then you can go monthly, maybe 3 years kind of thing.
Yeah. And what are you seeing? Because I haven't.
Well, actually, I can see us pulling back to 36, but just when, I don't know.
Yeah, back to, okay. And if we take a look, so I would take a look at this on the monthly because, boy, all last week, that's all that I heard about was the consumer staples sector. Now, do you know who the top couple holdings are that are inside it?
Well, you got to think Walmart's a big one, and then I think after that, you got Macy's.
Got it. Okay.
And I mean, I don't know if you've been to New York. You probably know some of the bigger ones that are there.
Yeah. when you take a look at this, I'm going to have to extend out the expansions here, because it's well past the 1.618 level. Let me see where 2.618 actually kind of measures itself here. Let me put this in red too. The thing is certainly on fire. The 2.618 level, it takes you up. It didn't work out on my system out here. But you got an A to B equals CD. Is this completed? Let's come off of the lows on the monthly, the March lows. The first swing point high is going to be April 30th. So I would say it's at least going to move up to the 1 to 1.618 level, which looks like about $39 and change, maybe $39.69 out there. That's what the monthly looks like. Do you play the XLP? Have you ever traded the XLP?
No, I haven't, but I think it was one of the callers, a number, either Tom's show or somebody's show.
Yeah.
Was talking about it, and I looked at it on a long-term chart, and I thought, man, oh man, that's a nice bellwether to keep an eye on. You know what I'm saying?
Yeah. It is, and certainly it's doing well out there. Of sectors, if there's going to be a pullback, I think the sector to be paying attention to is probably you get a decent signal here. Is that one of the things that you're saying?
Yeah, exactly.
Yeah, I think you had a decent signal here in the XLP. I think the energy sector is the other place to be paying attention to. I'd probably put those two sectors together to see if you get some synergy out there. But, yeah, it's a strong sector, no question about it.
Yeah, and I looked at the gold contract today, and I don't know if it's a 5-day or whatever. We've got an inverted head and shoulder pattern. And you can look at the GLD, and we do not have the volume today.
Yes.
And so I think we may go higher one more day on gold and then get a pullback to the neckline. But anyway, I think we could go one more higher on the spider if we hold up today, but we'll see.
Yep, we will. All be about the king. Hey, Thanks for calling, Rick.
Thank you.
You bet. 877-927-6648. Dow is up 16. S&P's off about 1.5 right now. We'll be right back.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of tfnn.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of tfnn.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
Catch Basil Chapman as he uses his Chapman Wave methodology to call the markets. The Tiger Technicians Hour, next on TFNN.
Welcome back, folks. Dow up 20 points right now. S&P's somewhat flat, down a point. And I think one of the, as I take a look at the opportunities for trades out here, it's the Great British Pound U.S. dollar currency pair that really has caught my eye. And so let's go take a look at it. We're taking a look at, right now what I've got up on the screen here is the daily chart of that currency pair. Now, one of the things I want you to pay attention to, right now it's kind of scrunched down. We're covering the time period, quite frankly, that goes back into the November 2009 time frame up to the present time. What I want you to pay attention to, and first I'll go ahead and get rid of this out here. If you're watching on Tiger TV, I've got a little tool, I believe, that I can use, and I'm going to go ahead and circle these areas. They show up in yellow, and what I'm doing here, folks, is I'm coming down into the areas where the Great British Pound U.S. dollar currency pair has moved into the oversold territory. So just highlighting those areas. It's one of the areas that you should be paying attention to on the stock chart, because what the daily chart is saying is this is getting into oversold territory. Why is that important? Well, what you want to do is you want to go back and take a look at those areas, because the pound has absolutely gotten pounded. And it's getting pounded to the standpoint that it is into the oversold territory. Each time, now this goes back here to 2010. So the first time that it was down and into the oversold territory was back in around the February 2010 time frame. Had a pretty nice little counter trend move. Went from the lows of about 151.80 all the way up to the highs of about 154 or close to it. Then what happens? It works off that oversold condition, moves back down, makes an even lower low. Doing it with, it looks like about less relative strength. But as it does that coming into the May 2010 time frame, then what does it do? Has a really nice counter trend move out here. Very nice move in the marketplace. I mean, going from the lows of 143, quite frankly, taking it all the way up to the highs here of 167. That was a big move in the currency marketplace. Next time it gets down into the oversold territory, takes you back in here to the September 28, 2011 time frame. Does a counter trend rally. Looks like, as far as retracements are, well, it makes a 100% move of a move. Was that? Yeah, I'm sorry. It makes a retracement. I jumped fast. I did the fast forward. Makes a 0.618 retracement. Next time down, when it gets into the extreme oversold territories, all the way back here in June of 2012. Remember, our market's made a low June 4th, 2012 out there, and then makes a counter trend rally, creates a 100% move of a move. We can see that level here, if we just simply draw a line across the screen, that level really holding as a key resistance area. Now, as we take a look at it, I don't have it drawn in yellow here, we can see the pound getting pounded and moving into that oversold condition. Now, as we take a look at this on the weekly chart here, what you're going to see is you're going to see a nice Gartley buy pattern. Hasn't completed just yet. And on the daily chart, which would be your trigger, you can see it's very close to doing that. And right around the 147.75-ish range happens to be a 1-to-1 A to B equals CD. I like the mere fact that on the C to D leg, you've got price well on the right-hand side. Means that the A to B leg was stronger than that C to D leg. You're coming in the 0.786 area. Not there just yet, but looks like on the daily chart, we had the overbought, oversold indicator. Even on the weekly chart here, you can see it's moving down on the weekly chart, even more oversold than almost at any other time except going back into the 2009 time frame. The Great British Pound U.S. dollar is setting up to be one heck of a nice currency trade out there. Just got to wait for the bulls to show up. If this 0.786 level doesn't hold, then you wouldn't enter the trade, and you wouldn't do it until you got some type of bullish candle out there. Folks, stay tuned. Basil Chapman will be up next. As we do on Tuesdays, we have the option hour following Basil. Daryl Martin from 1 to 2, David White 2 to 3, Ken Shreve 3 to 4, and none other than the Tom O'Brien Show from 4 to 6, folks. Thanks for being here. Have a great Tuesday. Look forward to seeing you tomorrow. Take care, folks.